Central banks are struggling to save the global financial system. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir. How are you going?
Pretty good. How are you doing?
Excellent.
So we've got our new arrangement. We're being a little bit distant because of current issues from a health perspective.
Yes. So in terms of the audience, I think the audience should know that, we'll see how long, but for a few weeks, we'll be recording from a distance. And, obviously with your wife's condition, the coronavirus is quite serious. But the show must go on, and whatever it takes.
Show must go on, and the format may be slightly different, but effectively the analysis and everything else will be just the same.
Absolutely.
So we should probably then turn to what's been happening with regard to central banks as they throw the kitchen sink and everything else you can conceivably think of to try and support the system.
Yes. What I'd like to probably start off, Martin, is to say, when we did our last show, we said that I think we recorded on Monday. We said that it was the greatest unleashing of monetary stimulus in the history of the world in terms of what happened early this week. So we've seen another range of announcements coming forward by central banks around the world, whether it's the Bank of England, the US Fed, the ECB, the RBA, etc. And they are really throwing everything they have to try to save this debt bubble. So we're going to go through some of that detail, and we're going to go through some of the Australian content, because I think that's quite relevant for our Australian audience. But the key point, I think, Martin, is that so far the financial system is in a delicate balance. We've seen particularly long-term interest rates, and we'll get into this in a moment. So these long-term interest rates are measured by 10 and 30-year bond yields. They have been heading in the wrong direction over the last few days. And our big concern is that if interest rates on the long end continue to rise, we will see a default by someone, a big corporate, a big hedge fund, a big bank, because these rising interest rates means that the interest service cost on the debt goes up. And given that everyone is deeply in debt and not a lot of income is coming in because of the grinding hold of economic activity, what that would mean is that someone won't be able to pay their debts, and that could lead to a systemic crisis. So we'll get into this in a second, but I think if anyone thinks that we're sort of out of the woods with all of the announcements this week, so far the financial system hasn't responded in the way that central banks would have hoped that the markets would have reacted.
Yes, and of course the bonds is a very important indicator of the health of the financial system, but of course it tells you very little about the real economy and what's going on there. And unfortunately everyone's fixated on financial stability. There's a broader question here too, isn't there?
Of course. So where we should start, Martin, is obviously we've been talking about the repo market, and I think the repo market is quite important because even when we saw the Prime Minister and the Governor of the RBA yesterday, I mean, they're all saying the coronavirus is the shock to the economy, and that's not my position, and I think that's not your position either. So what we've tried to educate our audience is to say that the repo market, which is the short-term money market for the banks, blew up in New York last September. The New York Fed had thrown $500 billion at the repo market, and without that, we would have had a financial crisis. So that's the real story, not the propaganda that the government is trying to convince the Australian people of. Now, when we recorded our last show, we said that as of Saturday morning Australian time, the bailout of the repo market had hit about $808 billion. Now, let's actually put slide one on the screen, Martin. So as of this morning, so we're recording Friday afternoon. So this is based on Friday morning Australian time, Thursday New York time. We're up to $1.0 $1.86 trillion. So we've hit the trillion mark, and we are very close up to the 1.1 trillion mark. So Martin, let's put up slide 2. And here is with slide 2. I mean, this is the key evidence that this is the repo market. Having said that, in the last few weeks, we have seen a dramatic escalation. So probably in the last 3 weeks. 3 weeks ago, we were about 600 billion. Now we're at almost 1.1 trillion. So the crisis has led to a surge of the pumping of liquidity into the market, but has probably brought the timetable forward anywhere between 6 to 12 months. And without the coronavirus, the economy is strong, everything was fine. I mean, that's completely BS, and yet that's what the establishment is trying to sell the Australian people.
And I should say that I will have bleeped out about 8 references to our current health situation from John's last paragraph, simply because if we don't, we won't get monetized. Just to be sure that people understand, YouTube is still demonetizing posts where mention is made multiple times of our current health condition, so we're going to be a little bit careful about that.
Okay, that's good to know. So I wasn't aware of that, Martin, but thanks for letting me know. So now, in terms of central bank activities, so why don't we just do a bit of a quick round tour of what we've seen so far. So obviously, I think we covered in our last show, the US Federal Reserve cut interest rates to 0. They announced a package of $700 billion in terms of quantitative easing. Now, so since then, what have they done is they've announced a special purpose vehicle to buy commercial paper. Now, what does that mean? It means that they're buying corporate bonds. So whether it's the repo market or whether it's the quantitative easing, that's around buying US government debt and trying to push those interest rates down. But one of the things that they have, the Americans have seen in the corporate debt market is that there's been a big sell-off in corporate bonds, pushing corporate interest rates up, and that obviously is that's a concern because a lot of US corporations are heavily in debt, and so in order to suppress those interest rates, they have started buying commercial paper. They've been buying commercial paper in the US market. Now, obviously, we've also seen the US Congress pass a package of $1 trillion in terms of stimulus. And basically what we're seeing, Martin, is debt upon debt upon debt, and kicking the can down the road by the Americans. And that doesn't seem like a sustainable position to me.
Well, of course, what we're actually doing is saying to people in financial difficulty, borrow more, it's really cheap. That's essentially what they're trying to do, right? So they're trying to make the banks lend more, but you need people, businesses and consumers who are willing and able to take on more debt. And the question is that very likely given the current situation?
Indeed. Yeah, I mean, Martin, the other thing I think the banks, or the central bank in America is trying to do is that obviously if corporates and households are unable to pay their whatever sort of debt they have, they're obviously trying to flush the banks with cash so that if there are an increase of non-repayments, that's not going to tip some of these banks over. So they're pretty much in a desperate situation. So obviously separate to the Americans, let's go to the Bank of England. So the Bank of England cut the cash rate to 0.1%. And as I was reading the press this morning, this is the lowest rate since 1694 when the Bank of England was established. So the fact that you've had nearly 400 years of history in England and we have the lowest interest rate on record, I mean, that should tell you that something is wrong, given that this has never happened before in the history of England. They announced an increase of $200 billion in terms of their quantitative easing. I think, might remind me if I'm correct, that the Bank of England has also announced the purchasing of commercial paper in the British market as well.
Yeah, that's correct. And the total quantitative easing is now £680 billion. That's a big number. Yeah.
And the other thing I should say is separate to the in terms of the Bank of England, we've also seen announcement by the European Central Bank. They've announced a quantitative easing program of about 750 billion euros as well. So now, obviously, the ECB has negative interest rates at the moment, but with a number of European countries being grounded to a halt, Italy being obviously prime candidate, again, they need to push these interest rates on these bonds down. Otherwise, you're going to see a default, and that is the name of the game that the central banks are up to. But as we said in our opening opening monologue of the show, so far we have seen interest rates on these bonds going the wrong way in the last 4 or 5 days.
Yes, and it's also, I think, just worth commenting on the fact that some of smaller central banks in smaller countries around the world, from New Zealand and elsewhere, they're all following the same path. So we are seeing central bank groupthink. They're all doing the same thing. They're all throwing liquidity at the problem. They're all taking interest rates lower. And they're essentially just saying, we're going to make it so easy for banks to lend to people that that'll solve the problem. And just remember that the biggest debt bubble in the world is getting bigger.
Absolutely. Now, we saw some big announcements in terms of Australia yesterday. We had we had a press conference from Scott Morrison, and he was talking more about both the economy but also the health situation. Then we saw a follow-up press conference by the RBA governor. And that was, I think, about 4:30 Sydney time, and they released their formal statement at 2:30. So kind of like what we flagged in our previous show, they did cut the cash rate to 0.25%. They did announce quantitative easing. So far, there's been no specific amount on the QE. They did announce a $90 billion facility that they're going to pump into the banks for the small and medium-sized enterprise sector. Now, so on top of that, APRA has suspended the 2016 capital requirements. So there were some basic capital requirements for the banks, and then in 2016 they announced some extra buffers, in order to shore up the banks. And they said that as of yesterday, they quote would not mind if those buffers were not met. And so obviously beyond that, so this Monday, Parliament will be coming back, and Parliament will be they'll be debating, I think, stimulus package 1, which we said last time was about $17.6 billion. And we have seen reports in the press that Scott Morrison and Frydenberg are working on stimulus package number 2. And detail of that package hasn't been released yet. So probably a couple of points about the Australian situation, Martin, is that so kind of like what the other central banks are doing. I mean, they are throwing debt upon debt upon debt. Now, I had a chat to Dr. Peter Brain, who we had on our show last year. He's forecasting that GDP for the second quarter could fall by 15%. Goldman Sachs says that could be the largest contraction of GDP since the Great Depression. So it appears to be quite serious. But obviously, when we have the biggest household debt bubble in Australian history, what the RBA is trying to do is to effectively bail out the banks. They don't want a default of the bubble. And they're trying to keep the bubble intact. And all they're doing is, printing more money, pushing more debt out into the system. And with this quantitative easing, we saw a massive failure by the mainstream media yesterday in trying to ask the governor some questions, because the number one question is, because the language from the governor was that we're building a bridge to get to the other side until when the virus is over. Now, the key question is on quantitative easing is, they're going to buy these bonds now, but how do they get the bonds out? How do they get them off the balance sheet down the track? We haven't seen a central bank so far post GFC that has bought bonds that has been able to reverse, that has been able to shrink their balance sheet. Now, I think I said to you, Martin, off camera, that technically in World War II, the Americans did engage in a small form of QE, but after the Second World War, the US Congress ran about a decade of surpluses, and with those surpluses, they basically bought those bonds back, and they drained the balance sheet of the US Federal Reserve. So, if Parliament doesn't produce some big surpluses in the next decade, this expansion of the balance sheet is going to be permanent. And obviously, all of this is on top of their announced repo operations, and that repo operations is a very large amount of money they have injected into the bank. So more debt, and obviously, the other thing is in terms of APRA. So suspending capital requirements for banks. I mean that obviously means that there's less capital reserves for the banks, which means there's less of a buffer. So what is APRA really saying? APRA is saying that we're going to allow the banks to lend more money to get Australians into more debt, and we're going to do it on a more riskier basis because the banks have a smaller capital buffer than otherwise be the case. Now, if anyone's from a common sense point of view says that we've got the biggest bubble in the history of the country, and we're going to get Australians into more debt on a more risky basis. How is that common sense? How is that public policy, Martin? How is that good public policy?
Well, I have to say I fail to see it quite. And it's also worth saying that some of the banks now have come out and promised mortgage repayment holidays. NAB has just come out, mortgage repayment holidays on mortgage repayments for up to 6 months, and also business repayments suspended for up to 6 months. So on one hand, they're suggesting that businesses should take more credit, and on the other hand, they're giving businesses the latitude not to pay the repayments that are due. So you can see that we are in a somewhat peculiar situation.
Yes. Now, the other thing, Martin, was that beyond all the measures we just announced, there was an additional measure of the Australian Office of Financial Management, which is basically the agency that issues all the bonds for the Treasury. They are going to buy about $15 billion worth of mortgage-backed securities, as well as asset-backed securities. Now, couple of key things there is we have had Christopher Joy in the AFR for weeks in his columns calling for this, and there's been some pushback by a former deputy RBA governor who basically said that we shouldn't be buying these securities, but we are bailing out hedge funds, we are bailing out parts of the private sector, as well as obviously trying to push these interest rates down on government bonds. But it was only in the last hour I put out a tweet, and anyone can go to my Twitter feed and have a look at it. I basically called out and said, well, is Christopher Joy going to get a bailout? And so one of the things I think is important is, well, if you're going to bail out the private sector, well, who's going to get this money? On what terms will this money be given? And I would think that, and again, we don't know who's going to get the money, but if we see that media commentators are calling for certain public policies that they personally can benefit from a commercial sense, and there's been no declaration of conflicts of interest, that would be, I think, a travesty in my view. And again, I called for Christopher to rule out that he's receiving federal bailout money, and so we'll have to see whether he responds to my tweet. And we'll obviously see. I'll be trying to chase this hopefully in the next few weeks as to when they do buy the $15 billion of MBS and these asset-backed securities. Well, who got the money?
Yeah, it's interesting. I just completed for DFA an interview with Michael Hudson, who's a very well-known American economist, and he made the point that all of this activity that we're talking about is designed to save the 10%, the wealthy, those who effectively are connected with the banking system and with those in power, and it's doing actually very little to support the 90%, those people, everyday people, who are essentially being crushed by the current situation that we're in. And I think that's probably true.
Yeah. So yeah. So before we get into what's happening with the financial system, so probably 3 concluding points about what was announced yesterday. So the first thing is that the RBA has effectively bowed out the cartel. So there is a financial cartel in this country. And so it is the commercial banks and hedge funds and all the people who make up the financial establishment. I mean, all of this money that was pumped into the system through all these mechanisms we just announced, it's a bailout of those people, because without that, all of these elite people like Professor Hudson's been talking about, they would have gone bankrupt. So it is a bailout of the system at the expense of the Australian dollar. Now, I had a bit of a going back and forth with an advisor in federal parliament yesterday, and we talked about whether there would be a vote of federal parliament on any of this stuff. And the only thing that parliament will vote on is the fiscal stimulus package. But all of the things that the RBA announced, and including what the Australian Office of Financial Management is going to roll out, all of this, they have legal authority already, and basically there is no vote of parliament. So basically, the cartel, the way the arrangements in this country have been constructed, the financial cartel is above parliamentary sovereignty, and they can make these decisions with no parliamentary scrutiny, no votes, and they can just bail out all their buddies. And that signals to me, Martin, that and perhaps it's a little bit controversial to say that in some senses democracy is dead. So you vote for a 2-party cartel, so coalition and the ALP, and by voting for them, you are basically voting for these so-called independent agencies to create hundreds of billions of dollars out of nothing and to bail out all of their buddies. And that doesn't seem justice to the Australian people.
No, I agree. And again, going back to Hudson's comments from a few hours ago, he was talking about Obama in 2008, because basically there was a view in the US at that time that they should let one of the big banks fail because they'd made so many mistakes. But actually Obama, who was basically funded by the banking cartel, said, no, we need to protect the banking system at all cost. So you can see how the political environment and the banking environment are so intertwined, and not surprising they look at each other's backs and never mind anybody else.
Yeah. So yeah, point one is the financial cartel has basically bailed out the establishment. So that's point one. Point two is obviously, and we touched on this point earlier, the RBA has no escape plan. So they say we're building a bridge, but how do you reverse all these measures once the sort of medical crisis is over? We basically have no they have no plan. And they've been not challenged by the mainstream media about this. And I had a phone call with a former member of parliament who's actually quite influential in financial circles, and he has been railing against the RBA privately and just said that these policies are complete madness, and they're building a bridge to nowhere as opposed to the bridge to the other side. So that's point two. Now, one of those things I would say, and I've sort of tweeted about this already, Martin, is in the last 3 days, I've had 3 members of the coalition, federal parliamentarians in the lower house, call me separately to ask about my views about where the economy is headed and where the financial system's headed. And on this issue of fiscal stimulus, one of the things I have told all 3 individuals, when it comes to the monetary stimulus and devaluing the dollar, and then in terms of this fiscal stimulus, I mean, basically the government is effectively going to bankrupt 2 or 3 generations of Australians in order to save the government today, as well as to save in terms of the banking system and the financial elite. And I've got 2 daughters. Hopefully, at some point, I'll have grandchildren. There is once we're almost. If you look at the federal government liabilities, we're close to $1 trillion already. So by the end of this, we could be $1.5 trillion up to $2 trillion worth of federal liabilities. There is no capacity to pay this debt back, and in order to save the moment, we are basically bankrupting 2 or 3 generations of Australians. I mean, that is criminal in my view. And again, they said to me, "What should we do?" So I said to them again, I put this on Twitter. A lot of people don't like it, but I said, let the system go, raise interest rates, get rid of the debt, slash government spending, run a budget surplus, and let's have a depression. Let's restructure the economy. Let's restructure the banks, and basically let's start again. I mean, this is your famous quote of "alt control delete." We need to restart the economy, and we need to restart the economy with a lot less debt. And there is now. Professor Hudson calls for a jubilee. Whether jubilees are, you could potentially try that. I'm not sure how legally a jubilee would work in Australia, but the alternative is actually to raise interest rates and to actually provide an incentive. I mean, when interest rates are so low, and the RBA governor said that these rates are going to be low for an extended period of time, there is no incentive to save. There's a massive incentive to borrow and to get into debt. And that's a very bad economic signal to be sending. And we need to change the incentive structure in this country around money, around debt, around savings. And yes, it's tough pain. There's a lot of suffering that happens in that process. But again, there's as they say, no pain, no gain. And I'm saying that the best course forward for Australia, looking at this at a 20 to 30, 40 year time horizon, is to take a short, sharp, extreme, in some cases, hit in terms of the economy over the next 4 or 5 years. But if you do that, we would come out on the other side in much healthier financial shape.
Yeah, and remember, of course, the debt has been building for many, many years through deregulation, through 2 financial crises now, and as you say, there's no way back. So, alternative strategies should be there, I think.
Yeah. Now. So probably, one of the things for our viewers, and I've had a lot of correspondence with our viewers over the last couple of days, is everyone wants to know, well, where are we today, and what is next over the next couple of weeks? So the the obviously big thing is that with this fallen income, because of the virus, what we are seeing is we're obviously seeing households and businesses and governments being challenged to pay down in terms of all of this debt. So we are seeing some stresses in the bond market, obviously corporate bonds as well as government bonds. So when you look at, for example, US government bonds, 5-year, 10-year, 30-year, the interest rates have been going up, even though they've been throwing a lot of money at the market. We've seen, when you look at Europe, you look at in terms of the German bonds, the interest rates have been going up there. Australian bonds, 10-year bonds, the interest rates have been going up as well. Now, fair to say that in the last probably 12 to 18 hours, the interest rates have come down a bit. It's a very volatile market. They are going up and down. But, I had some correspondence in the last couple of days with Mario from London, who's a YouTube commentator. He's known as Monaco64, quite famous in YouTube circles. He has the same view. Jim Rickards has the same view. I saw a couple of videos with Jim Rickards. But another guy is Bill Holter, who's also a prominent economist. I've had some contact with him, and the biggest concern is that if these long-term interest rates continue to rise, we will see a default. And Jim Rickards is saying we would see effectively the financial system freeze and potentially a bank holiday. And this is what Jim has been talking about in his books in terms of what he calls ICE 9. So we are seeing volatile interest rates, and if these interest rates continue to go up, kind of like I said, we will see some huge pain in the markets. So we've seen all the stimulus, Martin, from all these central banks. What I can say is that in the last 3-4 days, the markets and these interest rates have been heading in the wrong direction. We've seen a slight reprieve in the last 12 hours, but it's a very delicate situation, and a lot of this will be playing out on a day-by-day basis. But people should be effectively bracing themselves for the worst.
Yeah, there are so many uncertainties and variables, and the bond purchasing processes and buyback processes are just starting to fire up. So that's why we're going to see probably some easing of some bond rates in the short term. The question is for how long, and will it stick? Will it be enough? Will they have to do more? But of course, the unknown here, John, is that the health issue at the centre of this is going on for an unlimited amount of time, and we don't know how long it's going to be. Is it going to be weeks? Is it going to be months? And therefore, the underlying issues are going to be laid bare because of the fact that nobody knows whether it's going to actually get to an endpoint.
Yes. Now, the other important point, Martin, is we've seen from a number of central banks, they've said that even though they've thrown, all of this money, they've thrown all this money in the last 5 days, they've said that if they need to throw more, they will throw more. But the key, I think, point here is that they have effectively gone past the point of no return. They're just throwing debt upon debt, can't go back. They're just crossing their fingers and hope it works. So far, it's been very mixed results, but it's heading in the wrong direction. And just like we said in the title of the show, central banks are struggling to save the system. So obviously, if we think about what is this key climax point is, if a big financial institution declares insolvency, kind of like what happened in 2008, first with Bear Stearns and then with Lehman Brothers, we will see the system freeze up. We'll see credit dry up. That will be catastrophic for our banks. Share markets will tumble way lower than where they are today. There are commentators saying that even though the share market has fallen about 30%, the ASX 200 since the 20th of February, it's only a temporary thing because of the current conditions, and the share market will buy back. The share market will bounce back. That may happen. That may not happen. So it really just depends on what happens with these long-term interest rates and whether the banks can pay these debts when they're due, as well as the interest. Because if not, it's good night.
Yep. And I think I remember old Ronsfeld and his unknown unknowns, right? We are dealing with a very large number of unknown unknowns at the moment, which means that nobody can be certain about how this is going to play out. But I think we've got to expect more volatility and probably more risk to the downside.
Yeah. Now, probably a couple of points to finish off, Martin, is one is about informal capital controls. Now, I have been putting some posts up on social media, and I've been accused of trying to start a bank run. I have no power. I don't think I'm that influential that I can trigger a bank run in Australia. But I think the point to say to our viewers is that there is absolute evidence that it is much harder to get money out of the banks. There has been no formal declaration of capital controls by either the government or the commercial banks, but there are greater limitations in terms of how much money you can take out on a daily basis. And I've been receiving phone calls and emails and social media messages all week, and I'm sure you can attest to the same, Martin, that people are trying to get money out of banks, and that's becoming a more difficult process. And people, we're not trying to panic, but obviously we need to keep people informed as to where the status of the financial system is. It's fair to say that there has been a significant uptick in withdrawals right across the country, and it's not just our viewers. I think there's just Australians who are concerned in general about the safety of their wealth. There is an issue with the banks, and they are taking measures what they think are appropriate, but that obviously has an impact on people who have money in the system. Now, and obviously there's a lot of reaction on social media who say that this is my money, whereas I think this is why the show that we did a couple of weeks ago is so important, is because when you have money in the bank, you have given a commercial loan. The contractual relationship of that loan is the terms and conditions. And when you sign an application form for a bank for an account, you basically sign a document saying you agree to these terms and conditions. And what you think you signed for is not what you actually have signed for. And so, if you have a significant amount of money in the banking system and you are stuck at the moment, or you're getting the runaround from bank staff, I think that is likely to continue and potentially intensify over the next, probably a few weeks, few months.
Yeah, and there's a bit of practicality here insofar we know that banks don't hold a vast amount of cash on demand in the branches these days, particularly because a lot of people don't use it. And so if they start getting lots of people coming and asking, they're going to have to ration it to an extent. Whether it's more serious than that, I'm not sure. It's too soon to say. But we are certainly getting quite a number of reports where people have only been able to take out, a smaller amount than they hoped they would be able to. And in fact, in some cases, despite the fact they made a fuss and, started to complain, it had no effect. So it seems to be pretty consistent, John.
Yes. I've got to say that I want to sort of just talk about a couple of stories. So I had one person from Melbourne who has a couple of $1 million in the bank. He calls me up, I think 3 or 4 days ago, and he said to me he went to one of the big four and asked for $50,000 in physical cash, and they basically said that he needed to hire his own personal security guard and bring the security guard to the branch if he was going to take that money. Now, to be honest, and he had to pay for it. And so, to be honest, I found that quite extraordinary. Side story. In one of the businesses I work for, we had a customer only in the last 4 weeks who had $50,000 in cash, and he deposited that into one of the big four banks, and I was there during that process. Now, there was no request that if you're going to put money in the bank, you have to have security, but it just so happens that if you want to take money out of the bank, you have to pay for your own security guard. So I thought that was a quite extraordinary sort of turn of events that happened in Melbourne. And then another example is there was one bank staff who basically told one customer that the government doesn't want people to withdraw more than $10,000 out of a bank because cash can cause an inflation of the health crisis. Now the government has said nothing about the amount of cash you can withdraw from a public health point of view. So again, bank staff are coming up with excuses for why the withdrawal amounts have to be limited. Obviously customers are scratching their heads and thinking, well, why are they saying these things to me, and where are these things coming from?
Yeah, and of course banks do have a responsibility with if somebody comes in and asks to withdraw a large amount, particularly if they're older. The bank has an obligation to make sure it's not being done under duress or other things. So it is a bit of a grey area, John, in terms of banking practice. but they do seem to be having access to a bigger set of excuses than previously, at the very least.
Indeed. Obviously we've done a lot of shows about bail-in. We've also done some shows about the cashman as well. So all we've been trying to do is inform the public and give people information that they can't get anywhere else, and for people to make the best decisions, in terms of based on their circumstances. And so a number of these policies that we've been talking about for a number of years, they could well be enacted, if something was to go wrong in the financial markets.
Yes, it's unsettling, I know, for people. Again, it's a matter of watching and waiting to see how this all plays out, I think. But my own perspective is that with all the muscle they've thrown in to support the banking system, I think it's unlikely that we're going to see failures of banks anytime soon. I think basically the die is cast now that the banking system is going to be supported by the government until hell freezes over. But we'll see.
Yes. Well, yes. So I mean, I think the key point there, Martin, is they're trying. And obviously they said they will throw more at it, if required. But obviously, as we've said, interest rates on these long-term bonds are sort of been heading in the wrong direction. And, whether they throw more, if it's $2, $3, $4 trillion more to keep these bonds under control, what I would say is a very uncertain period. And there are international commentators like Jim Ricketts are saying we could be headed towards a bank holiday, and people should be prepared for that potential event. People need to understand what does that mean and how would it affect their circumstances if we saw that. And we'll have to just track these events as we go on a day-by-day basis.
Yeah, and that's exactly right. We will continue to report in the interest of the people and see how it plays out. And as you say, there are some people who are very alarmist at one end of the spectrum. There are others who are a little bit more sanguine. I'm somewhere in the middle personally, given what I've seen from the central banks, given that basically they're all saying they're going to do whatever it takes to keep the system running. So they'll absolutely do their best to do that. I think probably, John, there are both short-term and long-term consequences. In the short term, that will probably keep the banking system together, which is, on one side a good thing, but it creates a bigger problem, as we said earlier on, downstream. So whichever way you look at it, it's either a short-term pain or long-term pain. Sounds to me as though they've decided to go the long-term route and hopefully get through the next few weeks and then go from there. But anyway, we'll keep tracking, John. And in the interest of people, people should come here to see what's going on.
Absolutely.
Thanks for your time today.
Thank you.
And keep safe. Cheers. Martin North, John Adams, in the interest of people. We'll see you next time.